what does paying extra on your mortgage loan do? You don't want to miss this video. We've got 3 possible ways you can pay down your mortgage. Please like, share, and subscribe to our channel. We've got a library of videos to save you hours of research online. Number 1, you might have a large sum of money to make as a large principal payment at one time. You might have a big bonus, you might get an IRS refund, you might sell a property and want to pay it down. So we're going to talk about that first in a minute. The other is we're going to talk about monthly. You might make small chunk payments monthly. And the third is biweekly. So we get a lot of questions about biweekly. So we're going to talk about those 3. So first, we're going to talk about the large sum payment. So in this example, we just took a loan super close to $100,000, just for a super quick example. This loan actually is $104,250, okay, in the sample that we're going to use. So let's say that you have a large amount, you sold the property, and you want to pay $20,000 down on this mortgage. In this example, we're just going to pretend that you're on payment number 1, okay, so that you just got this money, you've already closed, you're on payment number 1, and your balance is $104,089. You've only made 1 payment. So when you make that large payment of $20,000, you literally are going to skip all of the payments on this amortization scale. You're going to skip down, and if you go to payment number 107, the balance on that is $84,010. Now that's the closest that I could get for this simple example. It's as if you've already made 107 payments. Now you're really only on payment number 2, but your balance per month is going to amortize quicker than it would have if you were still on payment number 1 or 2, which means that every single payment that you make, you are now going to be amortizing as you would have on the 107th payment. And in this example, your $475.43 a month is going to pay $220.98 to principal. Instead of when you were at that larger loan amount, you were only paying $160 to principal. So you can see that it really furthers you on that amortization table. Now it's important to note when you make a large principal payment and it goes towards the loan, as we mentioned, you're still responsible to pay monthly. It does not allow you to skip payments. So you don't want to skip a monthly payment because you will be counted late. So make sure that you make your regular scheduled payments on time. But my point in this illustration is that now you're paying as if you were on the 107th or 106th, right around their payment, meaning you're gonna pay the loan off quicker, but your monthly payment remains the same. Very important for you to know. Now the second way that you can pay down the loan is monthly. So monthly, you're making small chunks at a time, $100, $50, $30. So in this illustration, it's going to be very difficult for me to show you exact numbers because it depends on how much you're going to pay extra. So you definitely will chunk away at that mortgage, and it will again be applied to the principal so that every month your amortization, your principal to interest allocation is going to change faster than it would if you didn't pay anything extra at all. Okay, there's lots of amortization calculators online. You could probably find one and they're free, and you can plug it in and see how that's going to change your mortgage. But in general, making 1 extra payment per year. So in this example, if your payment is $475, by paying a mere $475 extra per year, you'll change a 30-year loan into a 21-year loan. Isn't that amazing? Just you can cut 9 years off your loan with just that small allocation. Now, the third way that you can also pay is some people choose to do bi-weekly. Now, a couple of things, my view of this might be tainted because I did bi-weekly at one time on my mortgage. I personally didn't like it. I'm going to try to get through this and just give you the facts of what I learned and things for you to consider prior to doing bi-weekly. Now, bi-weekly is a great discipline. It means that you pay every 2 weeks. So there's 52 weeks in a year, which is 26. If you divide 52 by 2, you get 26, right? So there's 26 2 weeks in a year. So the thought is, instead of paying monthly, you're paying every 2 weeks on this schedule, and you make an extra payment per year in the end, which, as we mentioned in the prior illustration, puts you ahead about 9 years from a 30-year loan to a 21. Now, people like this option because it's scheduled, it comes out, it can identify with their paycheck, so that if you take your payment, in this sample it was $475, so you would cut that in half, and every 2 weeks, $236 would come out of your checking account. For some people, it's a great management tool. Now, the thing that you need to be aware of is that there's a cost. So every time that this third-party company, it's a third-party company that administers the biweekly, every time they take out a biweekly, a half payment, they're charging you. It's anywhere from $3 to $5 what we find. So for that, that can be almost $10 a month. So you want to make sure you know there is a cost to it, because this company is administering these payments for you. They collect 2 weeks, and then they pay your payment on time. They collect 2 weeks, or 4 weeks, sorry, they collect 2 payments, 2 biweekly payments, and then they make your payment. So they're not actually paying your loan every 2 weeks. This third-party company is collecting your money, making your payments on time, and then when there's extra money, which there's 1 extra payment per year, they're paying it. So essentially, you could do it on your own and just set up auto draft, have it come out, and you don't have to pay any extra money. So just wanted you to be aware that there is a cost to biweekly that you need to be aware of before you do it. And it's a third-party company separate from your lender, okay? Good luck with your early payoff on your mortgage. Talk to you soon.